Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and I'm delighted to welcome you back this September for another edition of Barometer's Reading Webcast. I hope everyone has had an amazing summer vacation and that you had a nice, enjoyable holiday Labor Day weekend. On today's webcast, we will provide you with a brief macro overview. And of course, at the tail end of the conversation, be pleased to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. And with that, I am pleased to introduce our very own Chief Investment Officer, David Burrows. Good afternoon, David. Welcome back. I hope you had a great long weekend.
Yeah, no, great long weekend, and I guess for those of you in the north, we're done with wearing white pants and white shoes. It's time to get busy and get focused on fall. Pam, I'm gonna take a real high level view today. We're coming out of a pretty illiquid time of the year. A lot of folks away last 2 weeks of August, really the quietest 2 weeks of the year. We're coming into September. People always get a little nervous coming into the fall. Seasonally, we know that September, October can be difficult months. I'm always interested in the seasonality, although every year is different. We want to take a look at what the backdrop is coming in. Markets generally behave in the way that they are set up to react coming into news. And so we got everybody back at their desks and time to kind of look at what we're dealing with going into fall. We're going to keep it pretty high level today. We'll dive into a bunch of more specific topics as the month of September goes on. But just to start from a high level, we continue to believe we're in a structural bull market stocks. Nothing really to make us question that. Going back to 2013, market's been making higher highs and higher lows. Certainly the last 4 or 5 years, they've been tricky. The end of 2018 was quite tricky. 2020 going into COVID was tricky. And certainly 2022 was tricky with both stocks and bonds down in the same year. Very unusual thing. But that being said, we continue to work our way higher. Just to put it in context, we like to look at the last couple of secular bull markets. You tend to take sort of 4 steps forward, 1 step back. The step backs are cyclical declines, like we had in the early 1980s, like we had in 1990, 91, like we had in 1994. But in all cases, basically, we're lower bound by the rising 200-week moving average. And of course, we're always worried about the big declines like the tech wreck in 2000 or the financial crisis in 2008 and 9. We think the market looks really quite different than that and nothing alike, actually. And since 2013, same thing. We've sort of stayed above this lower bound rising 200-week moving average. It's a market started correcting 21 months ago. It's down about 6% off the highs at this point. Since the beginning of the bull market's up about 203% going back to 2013 over about 125 months. We compare that to what happened in the 1990s, which arguably was a wonderful bull market, went up 1,300% versus 200 over 217 months versus 125. That might suggest we are only partway through this bull market, and we'll talk a little bit about that. A couple of things I think that are really interesting in the intermediate term. Take a look at, this is from a friend of mine, Chris Cavacchio, who looks at, just long-term trends and moving averages. And of course, we're always concerned when moving averages are moving lower, which they were in 2022. But we saw that over the last number of months, they corrected themselves and started heading higher. If we look at all of the times over the last number of years where moving averages were headed lower, turned and crisscrossed higher. These are the various longer-term moving averages. In each case, it preceded a pretty significant run-up in price. And if we go back to 1982 and the bull market of the 80s and 90s, same thing. 1982, 1985, 1989, 1991, 1995, all wound up with long extended advances going forward, of course, but everybody's worried about what they've just been through. I think this is a really great graphic, and this is from a company called Endowus Research that looked at the longevity of cyclical bull markets going back to the 1930s. And once you went through the bear markets, the kind of amplitude and time period we went through before the next major correction. And if we go back over time in gray, all the bear markets, and over the most recent years, 2015, 16, 2018, 2020, 2022, we've only really just begun this next cyclical bull market. And we've been pretty consistent in saying we think that October marked the low of this most recent bear market. It's a cyclical bear market, may or may not have suggested recession. The non-recessionary bear markets that took place going back over the last 50 years tended to be sort of 18 to 24% and up to 18 months in length. And we believe that we're in a reflationary period. So one of the things that we feel very strongly about is we have to understand the backdrop that we're dealing with and make sure that we are looking forwards, not backwards, right? Most of us lived through the disinflation of the 80s and 90s, where slowly rates fell from high levels in 1981. The absolute deflationary period between 2000 and 2016, which is where we went through the tech bust and the financial crisis, and we got to 0% interest rates. And we really believe that since 2015-16, we began a reflationary period, which of course was interrupted by COVID. But what works in reflation is very different than what works in deflation or disinflation or outright inflation. And so we're going to push that around a little bit. When we look at the S&P in the most recent 18 months, this is the decline from the end of 2021 through the low in October 2022. Of course, the S&P is about the best performing market since that point, but it's been slowly marking its way higher with higher lows, lots of shakes and things to concern us. But, you know, even with this pullback that happened in August after a very strong June, July, this was about 5.6%, and the markets turned back higher from there. So we talked about in July when the year started strong and you had a strong June, July, it was very possible you have a 3 to 5% pullback in August. But that doesn't mean that there's something more sinister coming. The TSX looks a little bit better, certainly than it did. We've been putting in higher lows. We pulled back early in August, but interestingly, been very quick to almost recapture all that's been given up, because then some of the sectors of the TSX are behaving quite well. So it's no surprise, like we get corrections. You get 3, 4, 5% corrections a year. Maybe you get 1 10%er. Of course, when you get to 5%, everyone's worried that it's going to 10. So let's just question that a little bit. When we look at the S&P declining of 5% over a short period of time, and then having a day in the next week or so, which was up over 1%, when you look forward over the next 90 days, next 60 days, if we go back to 1980, maximum gain about 8%, maximum gain over 90 days about 9%, maximum gain over 126 days about 13%, maximum gain over 252 days, an average sort of median of 23%. So those short, sharp pullbacks that then reverse are actually a very bullish sign. When we look at the occasions that this took place, going back over the last number of years, here, they were all opportunities probably to be a buyer, not a seller. So outside the US, we've highlighted over the last year that we had the 12-month period where global stocks outperformed S&P. And when that happened, it tended to be that global stocks performed well over the next number of years. And when we look at some of the major markets, and some of them really have surprised people, that is the case. The Nikkei 225, the Japanese index, which went basically sideways in a giant trading range from 1991 to 2021, 30 years, came out in 2021. The thing that irked the Japanese market was disinflation and deflation. And as the world has started to throw that off, look, you got Japanese stocks started to rally. So this is currency hedged. But look, no sign of any weakness. In fact, even when the US stock market had some choppiness in the month of September, Japanese stocks continued higher. India is quite similar. Again, many years of underperformance, broke out, consolidated during the Fed's tightening cycle. But as we talked about over the last few weeks, it looks as though the market's looking beyond the tightening cycle, and those reflationary assets have really all started to lift again. Let's talk about bonds. So equities, we believe we're in a secular bull market, and that we've started a new cyclical bull market. Bonds, we've said for some time, we believe we're in a bear market. After interest rates falling over the course of 40 years, generating the biggest bull market in bonds in history, bond yields have been rising since 2020, meaning bond prices have been falling. And as is usual, people look backwards. And anytime you saw yields rally over the last few years, the expectation is, well, they'll drop very quickly, again, now to a lower low. In April, a majority of investors felt interest rates were likely to fall. Yet that's not the case. This is the aggregate bond index from 2020 through 2021 and 2022. Prices of bonds fell. This is an index of various issuers with various maturities and various credit qualities. We had a little short-term bounce through the late part of 2022, only for the sell-off to resume. And of course, now we're trading near the lows. If we look at the long end of the US bond market, it's the same picture. So as rates go higher, bond prices go lower. And this is particularly troubling because for some very risk-averse investors, they felt this was the place to go and hide from a big bad stock market. And that's not been the case. As most people know, we've been bearish on bonds all year long. We've had some very short-term, kind of 1 year and 2 year bonds as a place to hold cash. But we are not focused on the bond market as a place to make money. In fact, we think that it could be 15 or 20 years before you really make money in the bond market again. We're short municipal bonds. We are short Government of Canada bonds. We are short long-term US government bonds. We're short emerging market bonds. This has been a bad place to be, especially given the amount of debt that's being issued in the US and in other places. And just to put a point on it, 2023 is the third year of declines in a row, 3 years where bond prices were falling. The fall in 2022 was the worst year since 1788. And what made it really difficult for people was that not only did they see stocks decline, but they saw bonds decline. If we go back to 1962, you can see that in years where bonds were, so the S&P was declining, you had bonds rallying in most cases. 1970, 68 to 70 is an anomaly. But in our recent history, 2000, 2002, stocks went down, bonds went up. Stocks went down. 2009, bonds went up. In 2015, stocks went down, bonds went up. So what made last year feel so difficult is that both stocks and bonds went down a ton. At the worst point, stocks down 24.5%, bonds down 29% for a long-term treasury bond. So, felt bad. However, this is a very unusual occurrence and is very unlikely to occur again. Now, while we may be having negative returns again for bonds, again, this is not a place that we're focused. Yet again, people looking backwards, money flowing into bonds and cash has been extraordinary over the last few years. This is not a winning trade. People are afraid of equities. And this, I think, is the opportunity. When we compare the returns of stocks or the S&P relative to bonds, TLT, you can see that very clearly over the last number of months and years, stocks continue to outperform. So when I got in the investment business in the early 1980s, we learned the way you managed inflation or reflation was to own stocks. They had the ability to set price if you own good companies, the ability to grow their earnings and grow the dividends that they pay out, helps you to offset inflation. I can't tell you how many people have said to me over the last 12 months, maybe we should just put it all in the bond market. But look, this is not the thing to do. Very clearly, even coming into a difficult time in the year, stocks are outperforming. Dividend growth stocks relative to bonds, even better. So in our income strategy through the course of the year, we felt it was important to own companies with an improving ability to pay a dividend. This is where we think we can make returns going forward. If we look at the characteristics of our income portfolios, largely equities, the dividend yield for the portfolio is about 2.6%. The S&P is about 1.9. So they are slightly higher dividend paying securities. The 3-year dividend growth rate is about 15% a year. The 1-year trailing dividend growth rate is 21%. So our income stream has grown over 20% over the last year. And it has about the same volatility of the stock market and paying out a small percentage of the earnings. So we do think that bonds are in a bear market. When we look back at the last time a bear market started in bonds, when rates started to rise in the late 1940s, early 50s, it's really important to know what happened. Things don't repeat, but they rhyme a lot. We look at the period from 1950 to 1966, where rates went from 1.6 to 6.6. Bonds gave a 1.6% annualized return. Inflation was 1.6, no real return, period. Stocks returned 15% a year, or a real rate of return of about 13%. The things that led that bull market, and I put these up before, Philip Morris, Merck, American Express, IBM, Procter & Gamble, went up between 3,300 and 5,900%. These were all dividend growth stocks. So dividend growth is what tends to work in a rising interest rate environment or reflationary environment. Now we look at commodities. Commodities don't do well in disinflation, and they didn't from 2008 through 2020, where they started to rally. Through that period of time, any company that produced commodities put any capital spending on hold. Don't spend the money because we're not getting paid for it in our share price. The shares of energy companies fell 90% during that period. Metals and miners performed horribly. No wonder people don't like those companies. Now, since 2020, we had a great rally in commodity prices headed into the Fed tightening cycle, and that certainly put a damper on things. But again, 3 months ago, people started looking beyond the Fed tightening cycle, and reflationary assets started to lift again. So this is commodity prices themselves. We know that commodity producers have started to perform well also. And when that tends to start, commodities relative to stocks, it tends to go on for a long time, and we're only in the very, very early innings. Now, we know we need commodities for electric vehicles. We know we need commodities for infrastructure in the US. We know we need commodities to rebuild the power generation system globally to support electric vehicles. Yet people are not putting their money where their mouth is. As of July, we had the lowest exposure in investor hands going back over the last many years. Again, this provides an opportunity. If shares are not behaving the way you would expect them to behave, given what you think you know, then probably you're missing something. So the view that there would be a recession and China is weak should mean that commodity prices should collapse. Well, at the same time, we've got reshoring and infrastructure spending in the US after years and years of not spending money on capacity, and supply demand is tight. The ability to set price allows us to see rising dividends. So if we compare commodities versus bonds, commodities are outperforming bonds too. Again, somebody might think commodities are a riskier asset. Well, they were from 2008 through 2020. But today, they are outperforming actually bonds and stocks. Commodities ETF USCI, which is a broad basket of commodities, versus the equally weighted S&P 500, after many months of the Fed tightening cycle, has reemerged and is outperforming. So from a big picture perspective, we think that stocks are an asset to own, specifically dividend payers, in a world of reflation. And we put our money where our mouth is. That's what we own in our income strategy. In our equity strategy, we own things that benefit in a reflationary environment, including industrials and commodity producers and energy producers. because these are the things that have an ability to grow their dividend in this kind of environment. So we don't have to be everywhere. We need to find leadership. We need to always watch for change, new leadership emerging. And in the absence of leadership, having a willingness to sit on our hands and use our stop losses. Right? So it is a tactical approach. We use our top-down model to try and identify pockets of the market that are seeing net new inflows of capital. That's specific asset classes like commodities and energy and equities. We find specific sectors or themes. And then we identify securities that have financial characteristics that point to the fact that they are good and getting better, strong, getting stronger. And that's where our portfolio should live. All of these things contribute overall to generating return. Our job is to invest for the upcoming cycle, not for looking backwards. And it is often an unpopular stance to take because it's often things that people are not comfortable owning. So what is happening from a breadth perspective? Are things getting better coming into the fall, or are they getting worse? Let's talk about that a little bit. Okay, so as of the second week of August, we did highlight that our short-term and long-term indicators were showing a little bit of weakness. Now, we said this is typical after a strong June, July. We'll have to look at the groups we own to see if they continue to behave well. And if the groups that do well are the groups that are more defensive, that might tell us there's an economic problem on the horizon. So let's look at that. When the market was up 10% going into September and had a negative August, these are all the years since 1950. What happened in September? Well, the lion's share were positive. A strong year coming into August tended to mean, even if you had a sloppy August, September, and especially September to December, would be positive. They were positive 100% of the cases since 1950. Well, okay, what does the data say now? Over the last 2 weeks, our short-term indicators coming into fall are improving. The percent of stocks trading above their 50-day moving average for Canada, for the US, and globally all improved sharply. The percentage of stocks with positive weekly momentum started to improve. Percent of stocks hitting new highs versus new lows started to show improvement, and the percent of stocks trading above their 150-day or 30-week moving average improved. Now, it doesn't mean for sure this will continue, but it means that the footing we have coming into the fall is showing improvement. Let's see if the defensive sectors are looking any better, highlighting that maybe we've got some kind of problem coming. Well, probably the most defensive sector to own are the utilities. They're the highest dividend paying securities. The yield on the utilities ETF is 3.4%. Problem is there's not much dividend growth. Well, since September of 2021, this group has consistently underperformed the market and is sitting at relative strength new lows. No sign of a bid for defensive assets here. Let's take a look at staples. 2.6% dividend, but only growing at 5%. Not a ton of pricing power and relative strength collapsing. No sign of a search for a defensive asset here. REITs, real estate investment trusts, 2.8% yield, but sadly for this group, dividends are contracting. And this is across a broad range of real estate investment trusts. Again, the blue line, relative strength versus the S&P, continually falling. No sign of a bid for safety there. Medical devices, highly insensitive to the economy, relative strength, new lows. Now let's go across the street and look at reflationary assets. The price of oil is a good one. Price of oil, we know, is in a range from 2014 through 2021. We broke out. We went into a Fed tightening cycle. And look at this. At the end of July, oil prices broke out of the range that they were in and started moving higher. And we know that today, oil prices were over $90 a barrel after the Russians and the Saudis said they don't plan to increase their production after curtailing it several months ago. So companies like Canadian Natural Resources, which we've talked about, 4.1% dividend yield, growing at over 20% over the last 3 years, broke out in the month of August and following through in the month of September. It did get overbought early in 2022. In fact, rallied until April of 22 while the stock market was selling off. And now looking beyond a Fed tightening cycle. Well, this is not unique. The whole energy sector in the Canadian market, the capped energy index, again, started breaking out at the end of July and is moving nicely higher. Now, we've got all kinds of energy exposure through Tourmaline, which is a income producer, and Crescent Point and Imperial Oil, and we own Exxon, we own Hess. We actually own 13-14% of our total firm assets in energy. But again, we think after a long sideways period, when you break out to new highs, it's the beginning of a new bull market, not the end. These are companies that are generating cash that have an ability to raise dividends. And look at this, they're still not spending money to drill more holes. So not only is the US government sold off their strategic reserves, but companies are not increasing their spending because the board of directors are instilling discipline on management groups to buy back shares and raise dividends and pay down debt. Not just oil, uranium, same thing, another area of energy. Interesting, some of the mini modular reactors getting attention as a potential source of energy. We see that in Japan, they are turning nuclear power plants back on. In Germany, there is a move to stop shutting down nuclear reactors. And certainly there's a shortage right now where prices are higher for uranium than they've been in years. So we are in a more reflationary period. Energy relative to large cap growth stocks, relative strength hitting 3-month highs. Looking at it another way. If we post in blue by sector, the percent of stocks trading above their 200-week moving average, 200-day moving average, sorry, a long-term measure of trend, you can see the broadest rally is in energy, followed by tech and industrials. If we look in red, the percentage of stocks within these groups trading above their 50-day moving average, the strongest sectors, energy, industrials, materials, and financials. Technology has had some of the companies fall below the 50-day moving average, although they were stronger over the last few days. So we have a lot of exposure in energy and energy services. We have a lot of exposure in industrials and materials. If we look at the firm holdings, what's changing? Well, our tech weighting has come down a little, and we are underweight versus the index. Our view is that there are certain companies that are dominant, that generate a lot of cash, that have an ability to take advantage of what's coming in AI. And there's a lot of companies that trade at high multiples, don't generate any cash, and are going to have a hard time in a world of rising interest rates. Financials continues to be an overweight, largely in the insurance sector, companies like Fairfax that continue to perform well, a significant overweight in energy, a significant overweight in industrials, and a significant overweight in materials. We are underweight consumer. We are underweight healthcare. We have almost a zero weight in staples, real estate, and utilities. So we spend every day, every week, trying to see and recognize change. We know that the market doesn't move in a straight line. We know that people get nervous coming into September, October. We also know the fourth quarter of the year tends to be the strongest, and especially when the year up until fall has been positive. Going through the month of August, we got stopped on a very small number of positions, a couple in technology, a couple in the consumer sector. But largely our positions sailed through, and we come into the fall pretty fully invested, about 10% cash, maybe 15% in some portfolios. But I think that the positions are hanging in well. Now, I put this chart up a year ago. This highlighted the worst 9-month periods going back to 1950. And we were there in September of 22. And what we tried to say was 6 months out, it was highly likely the market would be higher, with some exceptions. but the average of all periods was plus 6%. 1 year out, virtually 100% of the cases outside of 2001 were positive, and by a lot. Well, we're 1 year out. We're a fair ways higher than where we were in September of last year. Different assets rally at different times. US stocks rallied first. But global stocks are performing well, and commodity prices continue to perform well. The most important thing is to look at what things would look like 3 years out and 5 years out from the worst periods that we've been through. And that what it means is that getting through those difficult periods and being positioned in the stronger sectors doesn't guarantee anything, but it probably puts the odds in your favor. So as we head into September, we think that the footing is pretty decent, and we're bound to bounce around a little bit. There's things that people are going to worry about, but I think that the backdrop broadly is positive. We're in a structural bull market. We're probably halfway through. What happened after all of these previous corrections is you had 2 and 3 year rallies that are what make market returns good over time. So we'll continue to watch for change. I'll continue these webcasts weekly. We're going to try and highlight the groups that we want to be focused in and specific stocks. And if things get more difficult, we'll play some defense. Markets try to make things hard. If it was easy, everybody would be invested and everybody would have the patience to generate a return over time. It's been difficult over the last 4 or 5 years. There've been lots of bumps, but we got to look forward, and we got to be positioned to take advantage of a reflationary environment. And I think that we are. So with that, Pamela, if there's any questions, certainly happy to answer.
Thanks so much, David. Yes, we have a question here. Alejandro wants to know, David, which metals do you like the most for a long position for a medium-term horizon?
Okay, well, that's a tough one, but let me see what I can share with you. Share screen. Okay. I realize I didn't put the VIX up in our discussion today, but interestingly enough, look at the VIX. 2020 spike, 2022 spikes. We're trading down around 14. We're about as low as we've been in the last few years, and generally the strongest market returns come during that period. I think in general, when we look across the commodities, there's a bunch that look good, and I'll run through a spectrum. If we look at uranium, uranium is quite attractive. You can participate in that. We own it through the Sprott Uranium Trust and the URA, which is the Uranium Producers ETF. I think that looks pretty attractive. Recently, we've started to see some strength in copper and iron ore. If I just run up here and pull them up one by one. Iron ore prices just are breaking above trend line that's been in place since September 2021. That's an important one for companies like BHP, great dividend payer. We also think, and this is one that is difficult for us to own, but individuals can own it. Labrador Iron Ore is a royalty company that generates dividends based on the Iron Ore Company of Canada's production. Let me see if I can just pull that up. .un. SBI. Where's it hiding? Oh, Labrador. Sorry. There we go. So this is a company that this dividend goes up and down with the volumes and price of iron ore. We like copper. I think the copper is looking quite interesting. This is the setup for copper. It's been in a tight consolidation. So many of the other commodities have already exited these pennant formations. And an obvious one here would be Teck Resources to participate in it. I noticed today that 4N Mining, which is a company we have a position in, a small cap, is breaking out here to new highs. If I put this on a daily chart, looks quite interesting. I think nickel looks pretty good. So really a broad basket. If we take a basket approach, there's a few ways to play it, but tech resources might be a good way.
Thanks so much, David. The next question comes from Sebastian. He says, David, won't higher oil prices be a headwind for equities?
Yeah, I mean, just remember that equities don't all act the same. High oil prices be pretty good for oil companies. High metals prices be pretty good for metals producers. Industrials are doing well because they don't need a lot of cash. They generate generally a lot of cash and not a lot of debt there, and we have secular demand for reshoring. But certainly high oil prices probably make it tough on a consumer, which is one of the reasons why we have a relatively small exposure to the U.S. consumer, about 5% of the total portfolio for a consumer. In fact, some of our exposure there is in, like Dollarama here in Canada, which tends to do well when things are a little tougher on a consumer. We are, in our macro strategy, short the XRT, which is the retail ETF. We are also short the travel and leisure ETF because you're right. Oil prices make it tough on a consumer. We broke trend here on travel and leisure back in August, and maybe some of that pent up demand for travel has worked its way through the system. So we got to pick our spots. I don't think we want to own everything in the market. We want to find those areas that benefit from a reflationary move. In the financials, Fairfax Financial, as a reinsurance company, behaving tremendously well, and higher rates. I mean, it's easier for them to meet their obligations in the future. So again, it's picking your spots.
Thank you so much, David. The final question asks, David, in the spirit of buying when everyone is fearful, do you have an interest in industrial REITs? You don't talk much about real estate, so this anonymous question is saying he assumes that we don't have much exposure there.
Yeah, we really don't. I mean, every asset class is helped or hurt in different kinds of environments. And one of the things that was helped the most during 40 years of falling interest rates were real estate assets, because for the most part, real estate buyers put down a bit of capital and take on a lot of debt to carry it, unless you're a pension fund or an insurance company. And if rates go from 2 to 4, it makes it hard on a AAA building for the cap rate to be 2%. If the cap rate goes to 4, price of the building's a lot lower. So if I had to own any real estate, we would own industrial real estate. And we have over time, but we don't own it currently. As I have often said, the best house in a bad neighborhood doesn't mean you make money. And so it might be the best part of a weak sector. And in general, I want to own things that benefit during a rising rate environment, not a falling rate environment. So, the real estate asset class is one that is a fairly obvious one to me that is going to have a harder time. We know what's happening in residential real estate. People's mortgages, are doubling and tripling. And there's companies like BlackRock walking away from commercial real estate. So you got to be careful here, I think.
Thanks so much, David. Well, that concludes the questions we've received this afternoon. And as always, we appreciate your insight and overview, and I leave you with the final word.
Look, we all have a real opportunity here because people have built this giant pile of bonds over the last 30 years, and they are hesitant to sell them. Now, there's some institutional investors that need to have them, but there's a lot of private investors who don't. And everyone has a different pain threshold. After 3 years, if you're losing money, probably you're considering reallocating some of that money. fear for a lot of equity investors is that prices go down. There's other risks out there. And, one of them is that there's more inflation than people think. And so we think that slowly over time, people will figure out that dividend growth is probably a great core strategy right now. That's something that we're, I think, good at, and we're very focused on. And I'd rather be here now and let people come in behind us and lift prices like they did through the 50s and 60s. Even though it may not be top of mind for everyone, I think the flows are going in that direction. So it's going to be an interesting year or two in front of us. And certainly we'll all, bide our time through September and the beginning of October, see how the markets handle the seasonality. But my guess is that underneath the surface, the backdrop is that things are in decent shape. Thanks everybody for tuning in, and we'll be back next Tuesday. We'll try to be specific with a few ideas. And if you've got questions, don't hesitate to reach out either by email or by phone. We're happy to talk to you if you're a client and worried about this part-time year, or worried about, how difficult it's been over the last 18 months. It hasn't been much fun, but we think we are relatively through it, and now we get to benefit from it. So thank you.